Hey everyone, and welcome back to the channel. Today, we're diving into a topic that sounds super complex, but is actually a powerful tool you can use to make smarter decisions with your money. We're talking about GDP. You've probably heard this term thrown around on the news, but what does it really mean? And more importantly, why should you care? Stick with me, because by the end of this video, you'll understand how to use GDP as your personal economic GPS. So, what exactly is GDP? GDP stands for Gross Domestic Product. Think of it as the ultimate price tag for a country's economic output over a specific period, usually a quarter or a year. It measures the total value of all the goods and services produced within a country's borders. Everything from the car you drive, to the haircut you got last week, to the software your company sells, it all adds up into the GDP figure. It's the single most comprehensive report card for a country's economic health. A rising GDP generally means the economy is growing, businesses are thriving, and more jobs are being created. A falling GDP that signals a contraction, which can mean tougher times ahead. Now, let's break it down a bit further. There are two main flavors of GDP you'll hear about: nominal GDP and real GDP. Nominal GDP is the raw number. It measures the value of goods and services at their current market prices. But this can be a bit misleading. Why? Because of inflation. If prices for everything go up by 5%, but we produce the exact same amount of stuff, nominal GDP will also go up by 5%. It looks like growth, but our actual output hasn't changed. This is where real GDP comes in to save the day. Real GDP is adjusted for inflation. It gives us a much more accurate picture of whether a country is actually producing more goods and services. When economists and investors talk about economic growth, they are almost always referring to the change in real GDP. So, from now on, when you hear GDP growth, think real GDP growth. This is the number that truly tells you if the economic pie is getting bigger. So, how does this number actually get calculated? It's a massive undertaking, but it boils down to an equation. GDP equals consumption, plus investment, plus government spending, plus net exports. Let's quickly touch on each one. Consumption is the biggest piece of the puzzle in most developed economies. It's everything you and I spend on goods and services, from our morning coffee to our Netflix subscription. Investment refers to business spending on things like new machinery, equipment, and buildings, as well as residential construction. Government spending is what the government spends on public services like infrastructure, defense, and education. Finally, net exports is the value of a country's exports minus the value of its imports. If a country exports more than it imports, this number adds to GDP. If it imports more, it subtracts. By looking at which of these components are growing or shrinking, we can get a deeper understanding of what's driving the economy. Alright, we've covered the what. Now let's get to the why. Why is monitoring GDP so crucial, especially for investors? Well, GDP is like the pulse of the economy. It helps us understand which phase of the business cycle we're in. The business cycle has four main phases: expansion, peak, contraction, and trough. During an expansion, real GDP is growing steadily. Businesses are confident, they're hiring, and consumers are spending. This is generally a fantastic time for the stock market. Companies are reporting higher profits, which tends to push their stock prices up. Sectors that do particularly well in expansions are often consumer discretionary. Think restaurants, travel, and luxury goods, as well as technology and industrial companies. People have more disposable income and are willing to spend it, and businesses are investing in growth. Then we reach the peak. This is the top of the cycle, where growth starts to slow down. It can be a tricky time because everything still feels pretty good, but the momentum is fading. GDP growth rates might start to level off or disappoint expectations. This is often a signal to investors to become a bit more cautious. Following the peak is the contraction phase. This is when real GDP starts to fall for 2 consecutive quarters, which is the technical definition of a recession. Businesses cut back, unemployment rises, and consumers tighten their belts. During a contraction, defensive sectors tend to perform better. Think about companies that provide things people need regardless of the economy. Consumer staples like food and household products, utilities like electricity and water, and healthcare. These are the essentials, and demand for them remains relatively stable even when times are tough. Finally, we hit the trough. This is the bottom of the cycle, where the economy stops shrinking and prepares for recovery. It's often a point of maximum pessimism, but for savvy investors, it can also be a point of maximum opportunity. Buying into the market when things look their bleakest can lead to substantial returns as the economy begins its next expansion phase. GDP data turning from negative to positive is a key indicator that a trough may have been reached. By understanding these cycles, you can start to think strategically about your own portfolio. It's not about timing the market perfectly, which is nearly impossible, but about aligning your investment strategy with the broader economic trends. For example, if you see several quarters of strong and accelerating GDP growth, you might feel more confident about investing in growth-oriented stocks. If you see GDP growth slowing down and inflation picking up, you might consider shifting some of your portfolio into more defensive assets or value stocks. Let's talk about timing. In the United States, the Bureau of Economic Analysis releases GDP data on a quarterly basis. They release an advance estimate about a month after the quarter ends, followed by a second and then a third, more complete estimate in the following months. The advance estimate is the one that gets the most attention, but it's also subject to the biggest revisions. The key here is not just to look at the headline number, you want to look at the trend. Is GDP growth accelerating or decelerating over several quarters? You also want to compare the actual number to the forecasts. Did the economy grow faster or slower than economists expected? A big surprise in either direction can cause significant market volatility. For example, a much stronger than expected GDP report could signal that the economy is running hot, potentially leading the central bank to raise interest rates to cool things down. Conversely, a much weaker report might signal an impending slowdown, prompting the central bank to consider cutting rates. These interest rate decisions have a massive impact on stock and bond markets. So, where can you find this information? It's readily available and free. You can go directly to the source, like the Bureau of Economic Analysis website in the US, or the equivalent statistical agency in your country. Major financial news outlets like Bloomberg, Reuters, and the Wall Street Journal also provide in-depth analysis and commentary as soon as the numbers are released. Many investing platforms and financial data websites also present this information in easy-to-digest charts and graphs. To wrap it all up, GDP is far more than just an academic term. It's a practical tool that gives you a bird's-eye view of the entire economic landscape. By learning to read and interpret this data, you can better understand the forces shaping the market, identify which sectors might be poised for growth, and make more informed, confident decisions about where to put your hard-earned money. It helps you move from being a reactive investor, swayed by daily headlines, to a proactive one, guided by long-term economic fundamentals. Thank you so much for watching. I hope this breakdown of GDP was helpful and empowers you on your investment journey. If you found value in this video, please hit that like button and consider subscribing for more content designed to help you become a smarter investor. Let me know in the comments if you have any questions or what other economic indicators you'd like me to cover next. Until then, happy investing.